Well, thanks so much for tuning into the Trade Setup. I'm Neeraj Shah. Good morning. In amongst key news, Ukraine apparently has said that they're no longer insisting on the NATO membership. This is AFP quoting ABC News, but this is a big one. US and UK have banned Russia oil imports. And hours after McDonald's, multiple other American companies, including PepsiCo, Coca-Cola, and Starbucks, have halted business in Russia. And apparently, after not much progress, Russia and Ukraine have said they will continue to hold talks on a potential ceasefire. But the third round of negotiations, as I said, produced little progress. So the key, viewers, is that while there is some bit of green light, apparent green light, if indeed Ukraine's stance of possibly not insisting on NATO membership is one. There is, of course, the consistent pressure on commodity prices, and which is something that we want to talk to an expert about today. A quick conversation with Jonathan Bharat. He's CIO of Probis Securities, and needs no introduction. Really, his views on commodities and oil in particular are well regarded now, and that's why we requested him to join us today early morning. Jonathan, great having you. Thanks for joining in. What's your sense, Jonathan, of what the last 48 hours of the to's and fro's and the ebbs and flows does for commodities in general and oil in particular?
Look, as we know, it's been very, very volatile. There's no doubt about it. I think the key is it's all about what each particular country is saying, which is swaying the market. So it's always on a knife's edge. If Putin says something, Biden says something, if Ukraine says something, then the commodities are going to react. But I think there is a core underlying theme that a lot of the commodities are in short supply. So any adverse comments will continue to send commodities higher.
Jonathan, how do you view crude? Because the opinions out there are differing. There are some who are, forget what the Russians think, because they have said that it could go to 300 if indeed there is a ban. Or what's your gut feel of whether oil has done its bit, or with these noises around, there is chance for some more upsides from here on?
Look, I think it's in my mind, obviously Russia doesn't mind prices to be high, and that's part of her leverage in terms of trying to get what she wants. I think it was very interesting. The UK and the US have said they're going to be banning Russian imports of oil. Mind you, for the US and the UK, it's affordable because it only represents 8% and 4% respectively. However, for Europe, I think it's a different kettle of fish. And I think if Russia starts to murmur, then you will see oil prices continue to trade higher. Now, we haven't quite got to the highs, which we saw in 2008, around that 148 a barrel. But the question is, what will cause it to move up to that level? I think a lot of us want to see it test that top end, but I think it'll only test there for a short time, like it did last in 2008. So I think the elevated price for oil is only until we get some form of concrete resolution coming out of the Ukraine. Hopefully it'll be sooner rather than later when people come back to common sense.
Yeah, that sums it up really. I don't need to add too much more to it. Just a word, Jonathan, on some of the other commodities as well, because there are some unnatural short squeezes happening. Nickel a case in point, but we hear so many stories about so many commodities being short in supply and there being supply chain issues as well, which could hinder transport due to multiple reasons again. What's your sense of where is the largest fear factor, and where is it that you believe there could be, even if there is a ceasefire, a bit of a sustained up move due to various other economic factors?
Well, I think the supply chain issue and the supply of commodities had been with us prior to the Ukraine situation. It's just been exacerbated by what's happened in the Ukraine. Some of our commodities, and it could be the nickel, could be coal, and it could be wheat and canola, where Ukraine are major players in that market. So I think when you look at it, that supply issue was already there. It's just been exacerbated. And I think that tightness is going to be there in those chosen commodities for the foreseeable future. It was quite a large move when you did see, say, for instance, nickel move up 66%. Obviously also with aluminium. I think we are looking for some still key drivers out of the Ukraine, but that is affecting that supply. And obviously, as I've just said, the supply tightness that we already felt due to COVID has just been exacerbated by what we're seeing with Ukraine.
Jonathan, again, just sum it up very quickly. Therefore, are you trying to say that because of the supply tightness that anyways existed, while the exaggerated moves due to the conflict might cool off, the elevated prices compared to what could have been the normal prices would still last for a bit longer?
Well, I think the supply issue we had been with us, and we'd seen some pretty strong moves, particularly say in the coal market, in the iron ore market, where the critical supply to the market wasn't there. I think with the Ukraine situation, it is certainly there. But when that starts to tighten, then that should ease the supply issues for some of these commodities. Commodities, as we know, have had such a huge rise, but as I said, when you look at some of them individually, which have been affected by the Ukraine, they've just gone over above. So I think it's more of a temporary situation. But whilst we've had those supply concerns before the Ukraine, they're going to be there until we get more supply.
Got it. Jonathan, really appreciate you taking this time out early morning and talking to us. Thanks so much and stay safe.
No problem. Same to you. Thank you.
That's the view from Jonathan Barat. We've been trying to do this, right? Day before yesterday, we spoke to Peter Maguire, who said that a dash to about 150 seems plausible. Jonathan Barat, for crude at least, Jonathan Barat saying that the erstwhile high 148, they could well be tested as well. But for some of the other commodities, if a ceasefire gets reached, then some immediate cool off anticipated. Well, it shouldn't surprise anybody, really, that view. Nevertheless, a quick check on what equities by and large did. So commodities have done what they've done. Equities had an okay day. It wasn't as bad as what some of the other days have been, but that is actually good news. And I would reckon that if one looks at what Asia and SGX Nifty are doing, you would probably see a similar sign. Maybe some green, but largely flattish moves. So as you can see, Nikkei maybe marginally, some of the others marginally off. But yeah, it's a bit of a mixed bag, if you will, on the Asian screen. It's a bit of a normal day. That's the point I'm trying to make. And the SGX Nifty should come up on your screen next. And let's pull that one up and see, after that 1% up move that we saw in our markets yesterday, some more upsides maybe. Let's wait and watch if this was indeed to happen. Now, what's the trade setup there for? Remember yesterday, viewers, I had said that I may get proven wrong, but the quant indicators are indicating that there could be some pullbacks. Lo and behold, surprisingly, not surprisingly, really, the quant indicators were right. The pullback did happen. And those indicators still continue to show possibilities of a pullback. So, well, that's probably good news. There was a short covering led move in banks on Monday, which will probably get extended today as well. But mind you, the flows were still on the negative side on the banking end. So I'll come to the equity flows in a moment, but keep in mind that from the start of the day yesterday as well, there were outflows seen in the banking counters, ICICI banks and the others. So what happened yesterday was a bit of a short covering led move in banks, and that could well get extended today. The question is, could there be buying that will come in? That remains to be seen. One notion that I want to debunk, again, I'm not positive, negative, neutral. I don't have a view really, but on IT companies. But this whole notion of how IT companies will benefit disproportionately on the MTM gains because of the currency depreciation, I think that's extending it a bit too far. Yes, IT companies in general benefit because exports become more competitive, but they are largely fully hedged. Any good IT company would be fully hedged, and therefore the sharp depreciation doesn't really result in any MTM gains. If anything, at times it could result in MTM losses as well. But the smart investor will ignore both the gains and the losses arising out of currency. These IT companies are so large now that their own individual treasury department kind of take stock. So I saw a lot of WhatsApp groups, some Twitter groups talking about how brilliantly benefit it will be to the bottom line. I doubt that will be the case. So keep that in the back of your mind. But overall, the business proposition for Indian IT companies does improve with the rupee depreciating. FIs continue outflows, as I said, 8,142 crores. DI is bought in about 6,489 crores, but FI selling is the real concern. Now, I would believe that at some point of time, such large selling would have, for now, this is continuing. There's no way of setting when we're there. If people like Mark Matthews can't point it out, I don't think too many other people can. But let's wait and watch what happens to the flows. Stocks to watch. Let's start off with the MOV function and just see what moved and what didn't in trade yesterday. And then we move on to the individual counters as well. So first, the key movers in trade. And as you can see yesterday, some textile names, Indraprastha Gas by virtue of that ₹1 price hike, if you will. Some reopening names like Lemon Tree and Inox Leisure, VIP, Lux Industries. So I think a clutch of those names did really well. What didn't do well was JK Cement because of the paints foray. The Adani Group stocks had some issues, and ONGC, by the way, cracked in trade yesterday 4.5%. So some of those, I mean, yesterday was a classic case of how oil and gas and some of the commodity names corrected and banks did well. So interesting to see if that trend continues today. IndusInd Bank would be in focus. The company is informed that the independent review by Deloitte on allegations with regards to the subsidiary Bharat Financials, they've made the disclaimers or disclosures thereof. They said it's a technical glitch leading to disbursements of loans without recording of client consent, which was the result of the IT change management and the process gaps. Clearly, a bit of a clean sheet, if you will. Jefferies came out with a note on IndusInd Bank. They maintain a buy with a target price of 1220. They believe that the independent review of issues around IRB's MFI loans by Deloitte is in line with the management's earlier indications. There are certain process gaps, but incremental financial impact may be limited as per the management. But they do believe that the bank needs to tighten compliance at the level of subsidiary, which may be integrated closer with the bank. So let's wait and watch if all of those happens or no, but largely a constructive view on the back of this announcement. India will restart scheduled international flights after 2 years, I think on March 27th. So Interglobe and SpiceJet remain in focus. Now, viewers, just keep in mind one counter view. Arguably, this should be meaning good business, good top line, especially for Interglobe Aviation. But at crude prices at such elevated levels and ticket rates being what they are, I would reckon that there could be losses. The more they run, the more there could be bottom line losses. Now, which way the street views this is a different kettle of fish. Maybe the street views that getting more revenues, finally these skies opening up is great news for these carriers. Arguably could be. Let's wait and watch if indeed by the time India opens up the skies, if crude prices were to retreat, then it's great news. Valuation wise, I mean, Indigo, for example, is in great shape compared to what it was some time back. So yeah, day before yesterday, at about circa 1600 or thereabouts. That's extremely strong valuations on a proposed EPS of maybe 80 or 90 or 100, depending on how you look at it. So let's see if there is some upside today. If these stocks react, you would know which way the street is thinking about it. But please be careful if you're trading them. Atul Limited was up 5% yesterday, but they've completed the expansion of sulfur black manufacturing facility to increase production, nearly 2.5 times of that production capacity. So that should be positive. February performance for some of the pharma names. So AstraZeneca registered the highest YOY growth, so that's positive, 24%, followed by Ipca and Torrent. So for them, it's great. Some of the others like Sun Pharma, Eris, and Indoco and Ajanta also outperformed the pharma market because largely most of the companies posted declines. Now, JB Chemicals, a worst decline of 17.4%, followed by Novartis, Glenmark, and Natco. And all the other listed drug makers also registered single-digit declines. So largely a month of declines. The likes of AstraZeneca, Sun, Eris, and Indoco did well, but JB Chemicals actually had a really poor February. Maybe the stocks react a little bit. If they do, you know why they are reacting. Two value calls. One of them is on CLSA on Phoenix Mills. So they are saying a buy. The target price has been cut, but they are saying that because operations are nearing pre-COVID levels, the stock is available at trough valuations. That should be positive. And then the other rationale, of course, they expect rentals to be about a 30% CAGR from FY22 to 27. And Motilal Oswal on HDFC Bank. Now it's a bank that is present in a lot of retail portfolios. Motilal Oswal conviction buy with a target price of 2,000. They're saying the stock has undergone a significant correction and is trading at 25-day, the standard deviation pivots 10-year average, while the growth and earnings outlook remains robust. Interesting thoughts. They continue to have it continues to be a high conviction buy in the banking space for them. The target price is premised on 3.4 times FY24 adjusted book value and about the 127 rupees from the value of the subsidiaries. So that is the Motilal Oswal view on HDFC Bank. If you're convinced, then well, the upsides could be pretty strong if indeed those target price come about. It's a stable bank, no doubt. It's maybe no longer as strong a franchise from a market's perspective as it used to be some time back, but nevertheless. So that's the long and short of it, viewers. A day in the green, largely anticipated. Let's see if that lasts. Be careful if you're trading at the higher levels, because the flows till now, at least, were continuing on the negative side, particularly for banks. So it'll be interesting to see how they behave after the bout of short covering is over. Thanks so much for tuning in. Have a safe, profitable day ahead.